Welcome to the market update for the month of February. Harry's off on a well-deserved vacation, currently in Australia, so we're wishing him safe travels on his journeys this month. The threat of tariffs began to weigh slightly on markets in the month of February, and we saw volatility in the market as measured by the VIX index remain elevated throughout the month. By the numbers, the S&P TSX was down 0.55%. The S&P 500, which measures the US stock market, was off 1.42%, and the Europe and Asia Pacific markets, as measured by the MSCI EAFE, was positive 1.8% in February. At the time of writing this update on March the 4th, the threat of tariffs has now become a reality as they were enacted this morning against many of the US's key trading partners, including Canada. And the markets in Canada and the United States reacted very negatively to this development. As of today, the S&P 500 has erased all of the gains that it experienced since Trump was elected president back in November.
So I think what a lot of clients are asking themselves, and some have called us even today and asked us, is what should I do? And I think at times like this, at moments like these where there's a lot of uncertainty, potentially fear or maybe panic in the market about what's to come, it's important to go back to investing basics. And two of the investing basics that we always talk to clients about when we review portfolios with them is asset allocation and diversification. So asset allocation refers to the percentage of your portfolio that's allocated to risky assets, i.e. stocks, versus the percentage that's allocated to conservative or safer investments, i.e. cash and bonds and fixed income like GICs. And it's that asset allocation that is really the driver of your long-term return as well as your short-term experience as far as volatility goes on a week-to-week, day-to-day, month-to-month basis. And obviously the higher percentage that you have in those risk assets or stocks, the more volatility your portfolio can experience in the short term. When markets are doing well, it's going to be great. When markets are a little bit more choppy or negative, you're going to feel that more in a portfolio that's asset allocation is more tilted toward those risk assets. Conversely, with an asset allocation that has more in bonds or safe assets, cash, GICs, the volatility will be more muted in the short term, but your long-term returns will likely be lower as a result. So it's moments like these, if you're an equity investor or you have a growth-oriented portfolio, which some of our clients certainly do, where you're going to feel a little bit maybe more uncertain or fearful of what may come because you know that your portfolio may experience some more drastic fluctuations in price. And it's important to remember that really the markets aren't negative over the last few months. And in fact, they're just kind of flat now. After they had been soaring when Trump initially was elected in November, it was a couple really strong months. And now with all the tariffs potentially going through, and potentially us having to live with them for quite a while, the market's trying to price that back in. But I think the important thing is to remember that most portfolios are very diversified, which is the other basic tenet of investing, that diversification is the only free lunch in investing, so to speak. And being diversified means owning lots of different stocks, owning lots of different bonds, and owning those stocks and bonds across various different sectors of the economy, as well as very different geographies around the world. And most of our client portfolios are very well diversified, so they're able to weather most storms that sort of come their way. That not to say that there won't be negativity, there of course can be, but your portfolio will still be intact and able to participate in that next bull market whenever it happens. And now again, there's nothing, this is just a minor correction so far. Of course, could it get a little bit worse? Yeah, it could. But our advice to clients and investors in general would be not to make any knee-jerk reactions.
Exactly. And to David's point about how you react to this, we do get a lot of phone calls of clients saying, now that these tariffs have been put in, should I go to cash? Should I do something drastic with my portfolio? And just like we saw with how kind of abruptly and quickly these tariffs have come up and gone down and come up and gone down again, they could end tomorrow. We really don't know what's going to happen. And so trying to time how this is going to play out is really outweighed historically by just staying time in the market. So we don't believe there's anything that anybody needs to do drastically right now. But if you are concerned about what's going on, or you have questions about how your portfolio and how you are diversified, please feel free to give David or myself a call anytime. We'd be happy to go through your portfolio with you.
As always, if you guys have any questions or concerns, we're here to address them head on, review your asset allocation with you, review the diversification and protection you have. And I think it's also really important, for our retired clients or clients who are approaching retirement, just remember that you're not going to spend all of your money in 1 month or 1 year. Drawing down a retirement income and drawing down a retirement portfolio is a process. And again, that's why we have asset allocation. We have different components to your portfolio. Some of your money may be in cash, some of your portfolio may be in bonds. And so if there is any serious sort of downturn for the markets, we've already pre-positioned for that. We can not sell those risk assets and take an income from those more conservative, safer investments during periods of heightened volatility. Now, things have just started to sort of hit a crescendo here with the tariffs just going through today, and the markets reacting to it yesterday and today, March 4th. Who knows what the rest of the week will bring, what next month will bring. Again, I think it's important to remember that with pressure from trading partners like Canada and Mexico, as well as other countries around the world, or just with economic pressures at home, pressures from their own constituents, their own governors and senators in the United States, Trump may do an about face, and he may choose to reduce the tariffs or impose a more lenient tariff rate at any moment. And if that happens tomorrow, next week, next month, hopefully not next year, but in maybe more of a longer term, you can see the market bounce back and rally really quickly and unexpectedly too. So usually it's best to sort of stay the course. But if anyone is feeling nervous, we're here to help answer any questions and review things with you.
Take care.